Alright, Savvy Trader here. We're going to go over how to calculate risk with options. Some key points to go over. Where do we place our stops and how do we calculate the loss when trading options? Now this is the question for today's presentation. So here are the basic parameters for an option or any trade. We're seeking high probability trades like the following. We want breakouts of compression zones, Heikin-Ashi reversal candles, stock trend in line with the SPY. SPY's going up, we want to go long. SPY's going down, we want to go short. The market internals support the trade. This is from the Dominator. Above VWAP for longs, below VWAP for shorts. Identify nearby resistance support levels. This could be price history, this could be moving averages, and also identify algo support and resistance levels. Draw these on our daily charts. And we want to know if volume is above average. So these are the basic high probability trades that we look for. All right, let's go over understanding option Greeks. Now this is the most basic level for calculations for stop loss and profit targets is the same. Delta is the amount an option price is expected to move based on a dollar change in the underlying. So if you have a delta 70 and price moves $1 for the stock, your option price is going to move 70 cents. And as a rule, we look for delta 65 to 70s for option strike selection. So you look for your 65 or 70 deltas and then look at your option strike. Can you go 10 cent higher or lower? Of course you can. It's not an issue, it's just a target. With directional calls and puts, a minimum of 14 days to expiration. 21 is better. Can you go 28? Yes. This is just your basic guidelines. It's a target. With advanced strategies, this will change, and we will leave that for another day. This is just basic directional calls and puts. Example for an option trade, doing the math. For example, we want to go long Caterpillar, and we want to buy long calls at a delta 65 or 70, 14 to 21 days out. Now let's look at our option chain on TOS. All right, we're in our TOS window right now. First thing you want to do is go to your trade tab, then go to all products. Make sure you got the correct ticker, CAT for Caterpillar. Then go down your option chain. Look for something between 14 and 21 days. We have one at 16 and 23. We do 23. That'll give us the 20th of January. That's fine. Then we're going to go to delta 65 to 70s. So let's do 66. Could do 71s. Those would have been fine also. So this is trading for January 20th, the 232.5 strikes, 1190 by 11.5. So let's put that all together. We have a delta of 66, days to expiration 23. Our price is 1190 by 1150. Get filled at 1190. And we'll move on from there. Okay, we're going to go into our stop calculation now. So let's find our exit. Now for our trade, based on the thesis of the trading high probability trades, our entry was based on the breakout of the compression with the bullish thesis. So we're looking for a long position, breakout of the compression to the upside. So our exit would be a breakdown through this zone, correct? Makes sense. Is that the only exit we can use? No, but this example, that's what we're going to go by. In addition, we have the 8 EMA near the same level. So that adds some support and also added confirmation that the trade is broken down. If it goes through the lower end of compression and breaks the 8 EMA, we're basically out of the trade because it violates our initial thesis. So I hope that makes sense to everybody. All right, now let's look at the chart real quick and put everything together. So our trade entry on the initial breakout of 239.72, the zone, we purchased the 20 January 23 calls, 232.50 strikes for 1190. A breakdown through compression zone, the bottom of compression zone is at 237.50. That would invalidate our thesis of a breakthrough compression zone and also a break of the 8 EMA. So putting it all together, so we get a breakout above the compression zone. If we get a failure of the breakout, it pulls back into the zone. We're going to stay long until it breaks the bottom of the compression zone and the 8 EMA. That is our out. Now, can it go below that in an intraday level? Yes. We're looking for a close. Let's say it's 10 minutes before the close and it's $1 below the 8 EMA. Do you wait till the next day to close the trade out? I typically would not. Depending on market conditions, I would probably close the trade at the end of that day and call it done. My thesis is invalid. It's no longer a bullish trade for me. I take my loss and I move on. You know, it's so subjective to the market. You just kind of want to have basic rules that you can follow and adapt those to market conditions. All right, we'll go into our stop calculation. So our entry was at the level of 243.50. Stop is below compression at 237.50. Entry minus the stop is $6. The delta is 66. We take the stop and multiply it by the delta, which is $6, multiplied by 0.66, our delta, which gives us $3.96. Take the cost of the option contract minus the stop loss. $11.90 was the cost. $3.96 was the stop loss, which gives us a total of $7.94. Now this is the estimated worth of the option contract if it broke the lower end of compression in the 8 EMA. That would be about a 33% loss. We didn't calculate theta decay, which is going to happen every day to our option contract, or the change in gamma, which is going to affect the delta when it changes and drops dollar by dollar. And it's not necessary for this example. You basically just need to do the rough math to see if it's within your risk parameters to take the trade on. It should take 2 minutes to calculate where your stop level is and multiply your stop and your delta to give you an idea. Are you willing to take that risk of 33% to put the trade on? That's the bottom line. All right, so what now? So you learn to do basic calculations for a loss on an option contract using your deltas. Now you must understand your risk when trading options and use a breakdown of thesis for these values, not an arbitrary 50 or 25% level. It does not work out consistently. You need to lean on the daily chart, calculate risk before entry. It'll save you from trades that are not in line with your risk tolerance. So this is a must. It takes 1 or 2 minutes to do it. All you have to do is calculate your delta and the price movement of the stock that you estimate, going up for a profit target, going down for your stop on longs, and do this on every trade and manage your risk. It's one of the most important things that you can learn. So I hope it all helps. This is Savvy Trader. Thank you very much.